Okay, guys. Okay, I welcome you all for this exciting subject, Principles of Accounting or Financial Accounting. And I'm your instructor, Jamal Heather. And today is our fifth lecture, and we are starting a brand new chapter named Accrual Accounting and Income. So, our first learning objective is explain how accrual accounting differs from cash basis accounting. Okay, so what is the difference between accrual accounting and cash accounting? So we have two kinds of accounting. One is cash basis and another is accrual accounting. Accrual accounting, it records the impact of transaction when they occur. Like in our assignment, when we have earned revenue, it means you receive cash right now. You record the revenue later. So these kind of transaction can be recorded in accrual accounting. But in cash basis accounting, only those records are going to be, or those transactions are going to be recorded in which we have cash receipts and cash payments. There is no accounts payable or liability here. So everything is on cash basis, right? So the accrual accounting also required by the law, which is generally accepted accounting principles, and it records the revenue when earned. So remember, he will perform the revenue next year. So this revenue belongs to next year, but he is receiving cash right now. So cash is going to be in assets, so no problem. But this revenue does not belong to this period, so it will not appear in this year income statement. It will appear in next year income statement. So that is the beauty of accrual accounting, that whether you book in advance or whether you pay in advance, you would be charged or according to accounting period. Understand? So expense occurred, is then it is recorded. Revenue is earned, then it is recorded. Whereas the cash basis accounting, it ignores the important information regarding who paid you and do you have the liability or not. In the case of accrual accounting, you have different kind of information. You can use those information with different kinds of stuff. Like we talked about in our previous chapter, we can manipulate the T account and find out how many, how many customers had paid us, what are the cash receipts, what are the cash payments, right? We talked about that. Similarly, it results in incomplete financial statements. What is the equation for balance sheet? Assets is equal to liabilities plus owner's equity. Now you are omitting this stuff that give you incomplete financial statements. And this is only used by small businesses, like a small grocery store at the corner of your street, right? A small shop owner, he can use that. Or maybe the barber, a beauty salon, small beauty salon, not the chain, right? Noodle shop, not a big restaurant. Maybe big restaurants are using a complex accounting system. So accrual accounting and cash flows. So accrual accounting records cash transactions such as collection from customers, right? So question is whether, now if accrual accounting can also record the payables and receivables, and can we find out the cash flows? In cash basis accounting, whatever is the profit, it is basically the cash based profit. If company shows 2000 profit, it is that the company, in company's bank account, there is a $2000 as well. But in accrual accounting, if a company make $2000 profit, It doesn't mean that there is a cash behind 2000. That's why we have a profit. Name profit is different than cash flow. So that's why there is a need to make cash flow statement, the fourth statement, right? Because sometimes the customer is paying us late. Sometimes we are paying our suppliers late, right? So in that case, that creates a cash flow disturbance. So that's why we are making cash flow statement separately. You understand my point, everyone? So how accrual accounting are recording the cash transaction? When they receive cash from customers or they collect cash from customers, when they receive interest earned, and what are the cash outflows when they pay salaries and expenses? When they borrow money, they receive cash. When they pay off loans, it is outflow. This is inflow. Issuing stock, because you just spread the piece of paper and receive cash. So that is also a cash inflow. So accrual accounting also records non-cash transaction. So in cash-based accounting, we do not record any non-cash transaction. For example, depreciation, right? We don't record in cash basis accounting. So how accrual accounting record the non-cash transaction? For example, sales on account. You are given the sales, so we make another T account called that sales discount. The nature is of expenses. So this is a kind of expense, but the name is sales discount. So we can also record this stuff. Purchase inventory on account. So you see, this is the non-cash transaction. No cash is involved. Your inventories are increasing and your account payable are also increasing, but there is no cash, right? Similarly, accrual of expenses, like we just did in our assignment 2, that utility bill occurred but not paid. There is no cash, but we have a journal entry. Similarly, with the depreciation, that the wear and tear of our equipment or assets, fixed assets especially, and the usage of prepaid rent, right? If we pay our expenses in advance, so that is called prepaid, and that are our assets, right? Similarly, with the earning of revenue when cash was collected in advance, unearned revenue. You receive your sales right now, but you provide services later. It means you are receiving in advance payment of the services that you didn't provide yet, but you will provide later. And the time period concept. So accounting information is reported at regular interval. The time period concept is that the basic accounting period is 1 year, which starts from January to December. And there's a research, it says that the 60% of the large companies, they use the accounting year as January 1st to December. So normally the governments, they use accounting year differently from June to June, 1st June to 30th June. Some companies also use this kind of accounting year, but it should consist of 12 months. A fiscal year may be ended on a date more than 31st, so we consider that as accounting year. So companies also prepare the interim period statement, or called the interim statement. For example, 1 month income statement, 1 month retained earnings statement, 1 week balance sheet, right? But requirement is that you have to publish the income statement of annual income statement. That's it. But the monthly, quarterly, or semi-annually are for the internal purposes. Okay, now let's discuss the revenue and expense recognition. We already talked about that, but let's talk this officially. That the revenue recognition principle deals with two issues. First one, when to record the revenue and what amount of revenue to record. So the crux is that revenue is record or recognized when business transfer the promised goods or services to a customer in an amount that reflects the cash or the market value that the entity expects to receive in exchange for those goods and services. So in simple sense, you will receive revenue, or sorry, you will recognize revenue. Recognize means you will consider the revenue when earned. Like in our assignment 2, the customer paid us in advance for the services, so that revenue is not earned, not recognized. So we will never include that revenue in our income statement. Everyone, please understand this principle. Revenue is recognized when earned. Simple. Chloe, Ajam, David.
No questions from my side.
Same for me.
Okay. So we have a global view here. So just pause the video and read it by yourself. It's not a rocket science here. It's just a law here. Okay. So applying the revenue here. Let me just move out the controls here. So apply the revenue and expense recognition. Here we go. So the exhibit 3.1 shows two situations that provide guidance on when to record revenue for the Starbucks. Number one, there is no transaction occurred. Why? Because customer planned to start drinking Starbucks drinks. There is a plan. It means there is no transaction here. Transaction. A latte, please. And then the Starbucks is giving us or giving her the latte. It means now the exchange has been occurred. How? The Starbucks is giving the coffee and the female here is giving the market value of that coffee or the price of the coffee, right? Here we go. Now the expense recognition. What do we mean by expense recognition? Expense recognition means, similarly, you record the expense when occurred. Simple. Record when occurred. So it has two processes. Number one, sorry, why is this happening like that? Number one, identify all the expenses incurred during the accounting period, measure the expenses and recognize them in the same period in which they relate the revenues as earned. Simple, like we talked about in our revenue. Revenue is recorded when earned. Similarly, expense is recognized when it is expense is recognized for the period.